I want to thank everyone for coming today. My name is Don Prattle. I am the Director of Trader Development and Education here at TradeStation. Our presenter today is Mr. Larry Williams. He's certainly no stranger to most of the trading community around the world. Today we are able to put the spotlight on him to get some of his insights. You know, Larry Williams goes way back in all of our lives, probably as if you're a trader like me or a broker or have monitored the markets, you know that all the time other teachers and financial service professionals would talk to you about taking a look at the charts and perhaps thinking about using that percent arb tool that Larry has developed and made many of us more adept with our trading. At any rate, Larry's long list of best-selling books includes 1982's How to Prosper in the Coming Good Years, and we hope that he's going to share all of that presentation with us today. So the Spotlight On series puts the spotlight on a number of our financial service partners, our education partners in the marketplace. We offer these free interactive webcasts with new speakers and new topics monthly, exclusive promotional offers in most of the webcasts. If you want to take a look at what's coming up, you can find them on TradeStation.com. Our presentation today is for educational purposes only. All of the symbols and trading ideas discussed here by our instructor is for a demonstration purpose only. It is not recommendations. There will be no recommendations today. Our presentation is not an offer or a solicitation of any kind in any jurisdiction where the TradeStation affiliates are not authorized to do business. Active trading may not be suitable for you. It's not suitable for everyone. Options trading carries a high degree of risk and is not suitable for all traders. Please take a look at the disclosure information in the PDF handout available in the Documents folder. That's also in that chat panel. Or you can look up these documents on the website. Today we want to welcome the star of our show today of Spotlight On. A new approach to technical analysis is our topic, and Mr. Larry Williams is going to lead the discussion today. So thank you very much, Larry, for coming in, and I hope everyone enjoys this.
Well, Don, thank you very much for having me, and I appreciate everybody out there coming to listen to an old guy talking about something that I think is new in the markets. And just a voice check, can you guys hear me okay? Somebody could, okay, good. And also I've been battling a cold here. That's fine, thank you. So my voice may come and go a little bit, and you know me drinking a cup of tea here. My apologies for that. And a couple of notes, some people had asked about my injury. I got injured the last day of last year. I'm recovering from that, was in the hospital for a while, and what a mess up that was, but we're coming back, that's for sure. So what I really want to talk about is something we've talked a little bit about before, but I want to address it in more depth now. And if you have questions as we come along, how can you get a cold in St. Croix? We're in San Juan, Puerto Rico where we got the cold. Can you believe that? Air conditioning. That's how you get colds in the tropics, air conditioning. So new approach to technical analysis, kind of like jumping out of a plane. You guys have seen these guys with the squirrel suits on. I saw one of them died just recently, one of the leading stars of the whole thing. And that's anything new has that potential. You don't know if the spacesuit's going to really hold up or not, do you? So we're going to kind of keep that in mind a little bit. If you have questions as we come along, I can't answer all the questions, but I will monitor them and try to answer the ones that either I think are the most fitting or that I can answer, because some you know, I get questions that I don't have the answers to everything. I don't. So we'll see how far we can go here. There is a disclaimer, of course. TradeStation's already given you theirs. You know, there's no proof that this is going to work in the future, et cetera, et cetera. And there's more disclaimer, hypothetical, simulated performance, da-da-da-da-da. You guys have probably already read all this as well, but, and there's even more. This business is full of disclaimers, isn't it? And if you do lose connection or it gets real bad, just log out and then come back on in. In fact, I just did that myself. The past is prologue. Technical analysis in the past, to bring a little history to this, has been about where we are. Are we oversold, overbought, we're under accumulation, the commercial is buying this market, or how we are, the structure of the market. Are we an uptrend, a downtrend? That's really been what technical analysis has been based on, are those 2 points. And a while ago, I mean, the point where I think we all want is what I want to talk about today, but I had a sense of how we can get to where I think we want to go, which is where will we be in the future? That's the big thing. And the only tool we've had for that has been cycles and cycle analysis to project where we might go into the future. Maybe there's something else that would do it, but that's the only tool I've had prior to this. And cycles, I think, can be really helpful, but I'm certain all you guys and gals have played around with them, and they're very ephemeral. They come and they go, and they're back and they're forth. So I wanted to try to get something that was more reliable, that I felt a little bit better about giving us a projection. And today all that changes. I'm going to introduce intermarket relationships, which I think give us a really good view of the future. In the past, we've looked at intermarket relationship, but more to say, well, bonds have been going down, so stocks should go up. We didn't, to the best of my knowledge, no one has ever used these intermarket relationships before to actually forecast today where we should be, or the general path or the roadmap for the next couple of months, 2 or 3 months. So that's what we're going to be talking about. I see somebody wants to know when I think the market will crash. Well, we're going to look at some things here, and I'll give you some ideas about what should be happening in the market. I do have some forecasts for you today, because that's really what this is about, forecasting the market. The idea is that one market can forecast another market. Obviously, if your stocks are really weak, bonds get strong. We've seen that before. If the dollar gets really strong, retail stocks get weak, because the cost of goods can increase quite a bit. The question, what about Dow theory? Wasn't that intermarket analysis? Dow theory is really about the trend of the Dow rail stocks or transportations versus the Dow Jones Industrials. So you may have seen me on Jim Cramer a couple of months ago. I did a Mad Money show with Jim, and interesting, I sent him 2 charts. One was on Costco, I'm going to show you that in a moment, and the other was on O'Reilly Auto Repairs. So this is the chart that I sent Jim. This is just before November. You can see the latter part of October. And our cycle forecast was a 124-day cycle. So this is traditional stuff that we should move up into the middle of December. And my annual forecaster said, yeah, we come up, we come down, and then we continue strong into the first of the year. So that's kind of like how we forecast before, using cycles and what I call my natural cycle. Now this is what actually happened. It came down, came up, and then there's a forecast for 2017. It's been coming down. So we get an idea that, in fact, we can get a glimpse of the future. Can we glimpse it entirely accurate all the time? No, we can't, or I'm not smart enough to know how to do that. It's just a glimpse, it seems, but my gosh, in the land of the blind, the one-eyed man is king, right? So it can still be very helpful to give us an idea. Now, the or Jim showed of the ones I gave him was Costco. And this is the Costco forecast. We should dip for Costco and then rally up, and then you see in the Cramer tape that we go higher in the stock. Now that red line, that's the forecast, right? And that forecast for Costco, and I'll bring that up to date with you. This is the forecast for Costco. And in fact, it dipped, it came up, it's followed the red line pretty well, and you would think that it should continue moving higher. So what is the forecast line? The forecast line is the dollar index pushed forward into the future. And my thinking is that there is a relationship between markets. One can impact another. Costco, almost a third of their sales are from overseas. Their operations are now in Canada and in China and Australia. So they're not only just a U.S. business, they have offices and stores throughout the world. And of course, they buy all sorts of stuff for their, if you have no sound, oh, then you can't hear me say this, but log out and come back in. So the dollar index, I think, can have a big influence. Now, let's say that Costco was a business just in America, but was maybe in real estate, so they're heavily financed. So then, most likely, we would think that the bond market could be a very good leading indicator of what would happen with the stock. I was on Kramer last week with another stock, Coca-Cola. Well, Coke, think about it. Coke buys about 2 million tons of sugar each year. That's a lot of sugar. So there's probably a relationship between sugar prices and Coca-Cola. So here's the forecast we did for Kramer. First of all, we looked at traditional stuff, cycles in the marketplace. This is the seasonal pattern for Coke. We see that usually right after the first of the year, Coca-Cola, not always, but usually has set up some pretty good rallies in the marketplace. So I don't think that we can say that there's any one be-all, end-all indicator. I like to combine indicators together, but it's interesting. We're at a seasonal low. But more importantly, if we take sugar prices versus the price of Coca-Cola, so this is a Coca-Cola stock, and this is sugar prices move 70 days into the future. Look at the relationship here of the two markets. And of course, it would indicate that we should see a pretty good spirited rally now in Coca-Cola. So that was a forecast. Now what's interesting to me about these, this isn't something that we just dreamt up. This is stuff that was on worldwide television, and you're seeing it actually how it played out in the future. To me, in the art of forecasting, that's the most important thing, is to take actual examples from the past and see did it really work in the future. Because anybody can forecast what should happen now, but you don't know until 3 months from now if the forecast was good. So we're going to be looking at a forecast that we actually made, like the one on CNBC television, so to show this technique. So you get the idea here, right? Doesn't Coke use more corn? Sure, Coke uses fructose for the most part, but remember, it's not just Coca-Cola. They have Minute Maid and 1,000 other beverages. But corn syrup is similar to the sugar market. If we had a corn syrup market, it would be even better. My wife Louise said, Larry, compared to the price of corn, you could do that as well. But what I'm showing you, first of all, I don't have the answers to all this, guys and gals. But the idea is like, oh, wow, look at that. There is a relationship here. Maybe we can learn how to use this relationship. So here's an example. Every week I do a market commentary called Larry TV. There's a whole bunch of you that are Larry TV subscribers that are watching today. So you remember, last October, we forecast what the yen should do based on this red line. I'll explain this in a moment. But this, again, is an intermarket forecast. And the idea is like, wow, for November and into December, we were looking for lower prices based on the forecast. And backing it up with cycles, we see that there's a cycle low here, a cycle low here, and a cycle low over here. I think maybe I need to get the red ball on to help with that. Yeah. So there's a cycle low here, and the forecast says this market really should continue going down. So we had the visibility of that, the yen market should continue moving down. And we finally got into late December, and there's the same red line forecast that you saw before. Finally, it says, oh yeah, now we can start to turn back to the upside in the marketplace. And this is what actually happened in the market. So here's the seasonal. We're getting a seasonal low. There's that forecast in the yen. Of course, it started a pretty good rally in here, which suggests in the middle of February we could have a pullback in the yen. So to me, this is a really interesting way that we can get an idea of where and how prices will be in the future. So in the case of that yen trade, the market was way oversold up here. It looked like it might be a good buy in here, but we have the visibility based on what impacts this market that probably not yet. And finally, we get into the buy point. You can see how that develops. Here's another example of cotton. The interesting thing I found is it's pretty applicable to all markets. In the case of cotton, we can forecast pretty well. This was an actual forecast we did on our Larry TV in the middle of December. Said, oh, we expect the market to dip and come up strong into February. That was a forecast. And here we are into February. The market had a little dip and moved on back to the upside. So I think that we're on some interesting stuff happening. Here was a forecast for soybeans made on Larry TV in December, middle of December. Soybeans should come down into February, late January, and then rally. However, it didn't really happen. So there's no perfection to this. I'm going to show you the good, the bad, and the ugly. And why this didn't work is because obviously I either didn't have the right cycle for soybeans, or I'm using the dollar here as the inverse relationship. I wasn't comparing soybeans to the right market. Or the third alternative, of course, like not a perfect world, and it's certainly not a perfect world when it comes to trading. If a couple of questions I'll try to answer here. If your cycle prediction goes as you expect, you hold your position 124 days. No, the cycle projection and the intermarket forecast projection are simply a trading guideline or a tool. I'm not going to buy because we're at 124-day cycle low and hold for 124 days. I just want a tool that suggests that I should be bullish on this market now. That's the more important thing. How far out can your forecast go? JR, that's a really great question. Some markets, and we'll talk about that in a moment, like if you want to predict the stock market, well, the stock market is very predictable or has a lot of correlation, let's say, with crude oil, with bonds, with the dollar index, with copper, with gold. So all those markets can be used to give us a prediction, and the correlations are different. So you kind of have to look at each market. Okay, so let's go to our next cycle. This is another one we had on Larry TV in October. So well, here's our projection for the bond market. In the bond market, we have pretty good correlation with what should take place in the bond market with two different markets. And the projection says around the 1st of December, the middle of December, this market should start to move to the upside. So that's a month and a half out. We get the idea of, oh, that should be the buy point, and then we should see a rally in the marketplace. Now, that was the prediction that we made, right? But can you always see the future? Well, this is actually what happened. There's the green line forecast you saw back here, this line, right? And lo and behold, we get there and we start the F move in the bond market. You know, bonds have been strong again this week as well. So I think that what I've always wanted is an idea of where I'm going to go. This is gold. In November, where is gold going to go? Well, it looks like come December we should start a rally in this market. So I want to look at these to give me an idea, and then when we got down into December, there's the forecast for the gold market based on the intermarket relationships, and says, oh, now we're going to start to rally in gold, and lo and behold, we did. So that's the idea of how it can work, and I hope you get a sense here that in fact, if you find a good example would be Starbucks. Starbucks buys a lot of coffee, or Dunkin' Donuts buys a lot of coffee. So there should be some relationship between the price of that stock and coffee. I mean, that only makes sense. JP Morgan should have some relationship with the interest rates because they're a big bank. I've done some work for a big fund. One of the stocks they're interested in is a fertilizer stock, and so we look at crude oil. Because a lot of natural sources stuff affect crude oil, and crude oil is a really good predictor of some individual stocks. Crude oil is also a really good predictor of China and Japan stocks because they're heavily dependent on buying energy. So that's what I'm looking for. There are some relationships. Okay, lots of questions here. I'm going to try to answer those in a moment. Do you do correlation? I use TradeStation. I'm going to show you in a moment how I do the correlations in TradeStation. I'm going to just go back and see if we've got what other questions would come in here? So bear with me, Mom. I'll read the questions. Oh, way down here. You have the ability to cover weighted intermarket spreads. I don't. I'm not looking at trading the spread here. I'm using one market to forecast another, so I'm not really doing that. Now the forecast line, how do you create this forecast line, right? So let's get into that. Let me show you that. If you forecast market A with B, how do you forecast market B? Okay, so let's go to how we do this stuff. Here's IBM. I'm going to show you a couple of examples. IBM, a huge international company all over the world. Guess what? Look how it correlates with the dollar index. Oh, and lo and behold, IBM starts to come down just recently. Now, in this case, the dollar index only forecasts out IBM for about 5 weeks. Some markets will give a further example, a further projection. We had talked about that earlier, that you really at the vagaries of what the market will do, how much it can give you. But clearly, we have a relationship with the dollar index and IBM, and guess what? It makes absolute sense, doesn't it? That there should be a relationship with these multinational companies. JP Morgan, we talked about that a bit earlier. Well, here's bond prices on an inverted scale, and this is where we are in JP Morgan now. I believe we should see a decline based on interest rates. You can see the nice correlation we have with interest rates and the price of the stock. So see how that works, how we can get an idea of, oh, clearly this is probably how I want to be working this market in the future. Does this type of thing have value for short-term swings? For intraday day trading, I don't think so, no. And I also say there's no money, serious money to be made in intraday day trading. The big money is buying here and getting out up here. Trying to dance in and out of here, there's not a lot of money to be made there. You combine multiple intermarket relationships. I do, but you know, another thing, remember, I'm still learning this. I'm sharing it with you now, but I'm still trying to learn this as well. There's so many questions coming in here. I wonder if I can open the screen up because I can't see all of them, so bear with me. How long do you make the correlations go back? I'm going to explain that in a moment. Is there a reason we chose IBM over large stocks? No, I just chose IBM as a test. That should make sense. Okay, so here's the Nikkei and copper. Look how the stocks in Japan are correlated to copper quite well. So a lot of it is just playing around a little bit, which you're going to have to do. And I'm going to tell you how it's done, right? So you can do this yourself. Is there any correlated market you can think of for the VIX? Sure, you could look at the stock market. You could look at gold as well. So some of these I don't have the answer to all these. I will give you the better correlations in a moment. So how it's done? Well, you're going to do a little bit of guessing, actually. First, though, in TradeStation, how do you extend into the future? How do we extend this line into the future, right? You better figure out how to do that. So let's talk about that. You're going to take a 2-day moving average of whatever market you want to extend into the future. And in TradeStation, you can then extend that moving average forward. So that's how you're going to be able to extend something into the future, because you can't extend the price itself into the future in TradeStation. Go back just so we understand how that's done. So this is the dollar index extended into the future by 40 days, 50 days, something like that. How do we do that is by taking a very short-term moving average, which you can push forward in TradeStation. Okay, so a lot of questions have come in here. What you use for crude oil correlation, you could use the dollar index for crude oil. I'm going to explain, just hold off on that a little bit. I'm going to give you what I found to be the better correlations in a moment here. I can't get everything for you. Do your 2017 forecasts include intermarket correlation? No, they don't. They're just based on cycles. Does this work on NinjaTrader? Hey, I'm doing a TradeStation seminar. I don't know how to do it on NinjaTrader. Okay, so you're going to take your moving average of price and extend that into the future. That's how you get your extension into the future. So here's how it's really done. It helps, first of all, to determine the most dominant or approximate cycle that's impacting the market under study. Because if you know that cycle, you can then look at that same cycle in the market that we think is having an impact. So first I'm going to determine a cycle. Well, how do I do that? I'm just going to count. Oh, look, from this low to this low is about 40 days. There's a low here. The market takes off 40 days. 40 days lower, about 40 days. There's been a rally in the price of sugar, which also means about every 40 days there's been a peak or some type of sell-off on the price of sugar. So generally it looks like sugar's got about a 40-day cycle operating on it, okay? So that's the first idea, like, okay, let's get the time cycle for the market and then look at that time cycle. Once we know the dominant cycle, we can extend the inner market that number of days into the future and try to find a fit in the marketplace. And it's a lot of work to do it, but as you can see, it's pretty valuable work to do it as well. So yes, Richard, in TradeStation, if you think you've got a 40-day cycle, you would push sugar prices or whatever you would push that 40 days into the future. And then you have to look at it and see, well, does it fit or not? I mean, it may fit or it may not fit. So you have to do that as well, right? So first I'm going to determine the influence. That's the cycle. Then I'm going to take the intermarket relationship and I'm going to push that into the future to see, well, is that true? It looks like it is, and it looks like the price of sugar should start to come down. That's the general idea of it. There isn't anything else I know that allows me to see into the future like this does. It's not easy. It takes a lot of work, and there's no sure thing. I mean, I get so many emails every day. I had an email today. A guy he's got $100,000. He thinks he can make $200,000 a year trading if he takes $1,000 a day out of the S&Ps. That's all he has to do. Sounds easy. It isn't. There's no straight path to heaven in this business, and we're still learning. I'm still learning this stuff. You really need to understand what we have here is an advantage. We have something that can help us. It's like all these tools that we have do. There's no absolute sure thing that's going to make you millions of dollars overnight, and I hope you understand that. So these are relationships that I like. To predict gold, I'm going to look at the bond market, crude oil, and the stocks in China because they import a lot of crude oil, or you could use Japan. These markets have been a pretty good idea of what's going to happen in the price of gold. Okay? To predict stock market, the Dow or the E-minis, the dollar index, the Japanese yen, copper, and the bond market have had good predictive values. Would weekly charts eliminate a great deal of noise? Well, probably, but I don't really, since this is not a fine-tuning thing, it's not going to come, I'm going to buy today. It's going to be a general idea of this week I want to be looking for a buyer and the trend should be up, trend should be down. So, it isn't an absolute buy today type of thing. It says, okay, this is what should be taking place in the market. Can these relationships flip-flop? Yeah, they can. Often we will invert, like the relationship between the Dow and bonds is an inverse relationship, so you're going to flip that moving average. To predict the bond prices, I want to use the dollar index. Lumber and copper have been very good to predict bond prices. Lumber doesn't trade very often, or it's very thin, I should say. That bothers me a little bit about lumber, but I've noticed there's pretty good correlation between those two. And my friend Tom McClellan has also noticed some correlations with lumber to other markets. It bothers me, though, that it's thin, but it's correlated pretty well with bond market. To predict crude oil, I like Japanese yen, stock in Japan, the dollar index, and gold. To predict the U.S. dollar, gold, yen, U.S. stock market, and bonds. To predict individual stocks, what does the company use? What do they do? What's the company all about? And once you ask that question, you can answer that question. Then you have a really good idea of the intermarket relationship that would work for you. How does world events affect this? Well, I'm going to prattle away here for a moment about world events. I don't think world events matter. Because in my world, I think that the cycles and these intermarket relationships predict the world events. I realize that's counterintuitive to everybody reads the news to see what's going to happen, but last year our forecast had a low predicted a year in advance at the Brexit buy point and a low at the year in advance at the Trump buy point. So we knew those events, we knew, but in quotes, we knew those events by the projections a year in advance, and the news came out. So I don't spend much time reading the news trying to decipher what the news means to the markets. I think that news comes out when it should come out, when these intermarket relationships suggest we should rally or cycles suggest we should rally. I think those are more controlling than news, but that's just my view. So I see a couple other people are saying, yeah, that's been their experience as well. You could use machine learning algorithms to look for correlation. Sure, Craig, you could do that. I'm not that smart, so I don't know how to do that. But you know, what I hope I'm doing today is opening a door that a lot of you are going to go, wow, look at this. You're going to learn so much more about this than I ever did or ever have. Hopefully you'll share it with me or do a TradeStation webinar yourself. But I'm firmly convinced now, based on about almost 2 years of doing these projections for my Larry TV subscribers and also for a fund I've been consulting with, we have nailed some calls way in advance in the marketplace. So I know I'm onto something. And really the purpose is to share it with you people. Can you please show what type of moving average you use? You just take any moving average you want, a short-term moving average like a 2-day moving average. That's all you have to have, and extend that in the future. A couple more questions. And just use a regular moving. Don't use an exponential. It probably doesn't matter if you use an exponential, whatever. It's a simple moving average is what I use. Is it correct to say you predict the gold? Yes, you can predict gold with dollar index. Okay, how do we push these forecasts forward? Again, you're going to push that moving average forward. Is IBM and dollar index negative correlation? Yeah. What did you learn about cycles? Wow, I'm still learning about cycles. You know, in the old days, I read all the cycles book. Jim Hurst, I got so confused by that book. All the Dewey stuff I've read, the foundation of cycles, just all the stuff that you people probably have. And my bottom line is cycles are really interesting. I'm going to draw something for you here about cycles. I think I can, that's the highlight bar. Cycles are like this. And so what we learned from the cycle, there should be a buy point here, right? A buy point here, and a sell up here, in here, and a sell over here. But what cycles don't do is tell us the magnitude. Cycles are all about time. They're totally time-based. They don't tell us how big the move will be. That's the problem with cycles. They're very helpful because they say we're in the area of a low or the area of a high, but they don't tell us how big the move will be. We need something else to give us the magnitude of the move. Yeah, John Ehlers has done a lot of work with cycles. Well, there's all sorts of stuff done in cycles. But my bottom line, my learning process is they don't help us much with the magnitude. So there I want to look at these intermarket relationships as an example to give me the magnitude and to give me more finite direction. And the commitment to trader report. If the commercials are heavily long, have been buying a lot of something, and we're at a cycle low, well, we're going to have a good move in the marketplace. So to me, I'm really bringing a combination of these things together. How and when will you know something is not? So many questions here that don't stay on the screen. How and when will you know something is not following your expected or predicted cycles? Well, the easiest way, if you're going to be a trader, you have to have stops in the marketplace, and I can be wrong. So we usually have a stop in the marketplace underneath a position, and if we're stopped out, we're stopped out because I'm not perfect, this isn't perfect. So we're going to let the market itself tell us when we're wrong. Does that make sense to you? The biggest problem is how much room to give for noise. I'll give it room because, again, I'm looking, well, let's see if we have some forecasts. We'll look at some forecasts and where we are. It's a new concept. It's either in its infancy or in its final death throes. And you guys and gals are going to have to wrestle with that yourself to see what you can do. I think it's a new arrow for technical quivers. And you're going to take this and work with it and play with it. And some of you are a lot better at computer research than I am, so it's there for you. Sam wants to know where you place your stop loss. Well, just a traditional trailing stop loss, Sam, is going to work if you don't know where to do that. If you don't know where you should have your trailing stop loss, you probably shouldn't be trading yet. So here's a forecast for the gold market, okay? So let's talk about natural forecast. I made this last week so we can get the PowerPoints done in time for TradeStation. So the forecast says that we should continue moving up until about the end of February, have a dip, and about latter part of March start to move back to the upside. You can use one standard deviation or stop loss. There's a lot of stop loss formulas. I think I've even talked about in other TradeStation webinars, so say go back and look at those. Question here, I could know how to do this. Usual range. Do you find that down moves are 20% shorter than up moves? No, down moves can, look how long this down move has been in the goal, a long time. This is what, there's nothing precise about the markets. You can't say we will go up 14 days and then we'll go down 28 days. You've got to react to the markets. Everybody has these absolute rules. Throw them out the window. Good game. A good example in the Super Bowl yesterday. There's no way that the Patriots should have won the game. In the last 90 games in NFL playoff league, in the playoffs, when somebody was down by 21 points, they lost. 90 times in a row, they lost. The Patriots came back and won because they adapted to the situation. That's what you got to do as a trader. You got to adapt to what's going on. You got great skill sets and great tools. That's what Tom Brady had. The biggest thing about that game is the mark of a legendary champion is somebody who comes back from when they're way behind. And that's what Brady did. That to me was the most encompassing view of yesterday. Here was a guy who had a huge margin call, way down in front of the entire world, and he came back and won. That guy would be one great commodity trader. And that's a good mindset to think about in your trade. You're going to have equity drawdowns, but the ability of a champion is to come back from when you're behind. Okay, so there's our projection for gold. So we have this little cycle projection as well. So the cycle projection and the intermarket projection tells me I probably want to look to be a buyer somewhere in early to mid-April, and I want to try to look for take profits in gold. No surprise to me that gold has been strong since we did this and this week again to the upside because the intermarket relationship, that's what it's been calling for. And I'm just using a closing price of a 2-day average of the price pushed forward. How do you handle times when commercials are saying something different than what cycles are saying? Paul, if I have a mixed message, commercials are bullish, cycles are bearish, and you know what? It's confusing. So why trade? I only want to trade when I have everything saying, Larry, you got to trade here. That's what I'm looking for. So it's like a party, the more the merrier. So if there's conflict between the indicators, why trade it? Walk away. If you cannot figure it out, walk away. What's the ideal stop loss for a market? The ideal stop loss is a function of a lot of things. Your emotions, your bank account, how much risk you're willing to take. So I can't say, oh, here's the ideal stop, because I don't know what your emotional content is. Generally speaking, the lowest low last 5-6 days, something like that, is probably a good trailing stop. Okay, here's the forecast for the stock market based on the dollar index. So this is the dollar index, just push forward about 30 days. And that's all this is. And there's a pretty good correlation with this, which would suggest to us now that we'll see the market start to come down. How do I handle alternating cycles? I don't. I just try to find the dominant cycle in the marketplace. And I know that it's not perfect. And it probably won't hold up perfectly in the future either. So I just want to get a rough idea, and then I go into get the intermarket relationships. Because these intermarket relationships, like, whoa, look at that. Yep, Trump rally. We were up all night long buying down here. And it went, as you Larry TV guys know, it went right to our target. That was it. Step in and buy. Right, we should dip up. So this buy point was known back here. This little dip here was known a month in advance. So the projection now is we should see the stock market start to move to the downside. Will it? I don't know. But that's the way I'm playing it now. I'm looking for, I would want to take sell signals here and be a little leery of buy signals because my intermarket relationship suggests we should move to the downside. See how that starts to come together for us? The nice thing is we have that visibility in the future that we haven't had before. It's all about we're overbought, we're oversold, commercials are buying. Or cycles give us an idea of the future, but They're so ephemeral. This is not ephemeral. This tells us buy area here, sell area up there. Okay, so some are pushed at 30 days. Some are. How do you know how many days to push it for? All you have to do. That's the work part of it. I spend countless hours doing this, pushing it forward, bringing it back to get the best fit. See what is the beat this market has to that market. That's just a question of work, Steve, and you're just going to have to work at it. That's all that it is. Show us the dollar chart, then it's moving. I don't, unfortunately, I don't have all the charts that you guys want me to have here. Why don't I forecast? This is it, Thomas. Great. Thomas has got it figured out. Your forecasts are basically a very short-term moving average shifted into the future by the length of the cycle. That's the basic idea, Thomas. Yes, this is a short-term moving average of the intermarket. We're going to figure out the cycle so we know about how many days to push it forward, and then we're going to play with that to get a fit for it, to see what it really is. That's it. Okay, somebody says that I'm sure they're aware of something here. Let's see this. How do you construct a Williams cycle indicator? That's in TradeStation. It's just a function you can put in how many days you want to look for a cycle. Why don't you forecast the stock market with its own moving average? I don't think moving averages forecast the same market. Oh, someone in Adelaide, Australia is getting a lot of echo. I apologize for that. You know what you want to do is, it's Lee Darcy. Hi, Lee. How you doing? You probably want to just watch the one that they're taping when they put it back on their YouTube channel. How many years do you need correlation to go back to be strong? You know what I found, Richard? That's a great question. Thank you. These correlations will vary. So I'm looking at over the last 6 months to a year, because when the energy markets are falling apart like they were a while ago, they have a lot more impact on the stock market than when they're just in a trading range. So you really have to pay attention to this at all times. How many failures before you bail out of the chosen correlated market? Well, if the correlation is there, I'm going to continue to try to trade that direction of the marketplace. I'm going to give me my bias in the future. Aussie dollar. Van, I don't have the Aussie dollar up here. I don't know what correlates with it. I haven't researched that. So you're going to have to do that. You select the best matching market. What I usually try to do is think about what market should forecast the other market. And then the game begins, just doing the, the cycles and the forecasts and all that kind of stuff. That's where it really begins. Is there a webinar direction on how to move a moving average forward? The TradeStation guys can tell you that. What is the difference between your natural cycle and normal? Well, I do a forecast every year, and I use what I call my natural cycle because it's a fixed cycle that seems to work for all markets. So it's naturally occurring in every market. I use the exact same formula for gold as I do for IBM or for the dollar index. So it's not a cycle that varies. It's a fixed locked-in cycle. You analyze fundamental conditions before you study forecast correlation. See, that's what I think is neat about this. This is a fundamental condition, right? We're looking at Coca-Cola and the cost of sugar. That's fundamental to that company. We're looking at the dollar index and stock prices. That's a fundamental consideration. So we're really getting a little bit past just technical analysis, and we're using some fundamental things. Okay, so more. Well, work with this yourself. You got to think about this. This is a lot of thinking about what's the time frame, what market influences it. If you like this stuff, you could do my Larry TV at 25 bucks a month. It's probably the best price of anything out there, where I do show these and talk a lot more about it. A lot of your Larry TV subscribers. Any plans to do any webinar talk about? No, I'm not going to reveal my natural cycle forecasting thing. Louise knows the formula. Nobody else knows the formula for it. So we're keeping that one to ourselves for quite a while. When will the recording be available? They'll send you a note. Is a 2-period moving average in future, do you need an intermediate relationship? No, you're just going to take a moving average because what we think, remember, is we think that we can just move that into the future. Say, oh yeah, look, we have a fit here. So don't get too hung up. You could use a 3-day average, 5-day, 1-day average. We're just trying to get a fit in this marketplace because these things do seem to influence each other. Will you be doing another art of short-term trading seminar? I don't know. I'm about seminar out. Sometimes the market goes completely against the forecast. Yeah, if the market goes completely against the forecast, you got to be out, and it shows how weak the market is because it shouldn't be doing that, so it's probably an excellent short sale. You consider using markets to move contrary to verify markets to confirm. Yes, I've looked at that, and can you explain a little bit more about what you cover in Larry TV? Sure. Larry TV is once a week. Occasionally we take a week off. And I review the markets that I think are the most set up for commitment to trader reports, cycles, intermarket relationships, for whatever reasons. So I'm not going to follow the market you like necessarily. I'm going to follow markets that I think are ready for moves. It's all about focusing on markets that are ready to have moves. Any new research on tides or astrology? I don't know anything about astrology. I think that solar has a huge impact on weather and the markets, but astrology and tides, you're going to have to go to somebody else, my friend Larry Pesavento maybe, or Chris Carolyn, but I'm not it. Well, can you talk a little bit about stock market? Yeah, this is my view. Then you stock market guys, you definitely want to go back. We did a stock market webinar on TradeStation. Isn't this great at TradeStation do this for us? To let us give these webinars. There's so much information there, not from me, but these other people have really done a lot of stuff. I did one on showing unemployment and how that correlates to the stock market, and it's huge. If you want to call a stock market top, I'm convinced you can't do it with anything that I know technical. And that's 55 years in this business, and I have looked at everything, and I can't find anything that really calls stock market tops. Fundamental things I think do, like unemployment data. I did a whole webinar on that. Go back and look at it. Right now, fundamentally, unemployment is very bullish. We're not in a recession. We're not going to go into a recession for a couple of months. So until there's a recession in sight, my strategy in stocks is to be long and or buy market sell-offs, buy big dips, and maybe sell rallies, take profits, and wait for a big dip again. We are in a bull market. We're not in a bear market. These Cassandras, the purveyors of pessimism, have been wrong for the last 8-9 years. They're still wrong until we get into a recession or a recession sell signals, and we're not there. We're not in a negative economy, and the best indicator of that's unemployment. So watch the unemployment numbers. If that changes, well, I'm going to get bearish. But right now, no way, Jose. So I talked a little bit about that. How do you determine which should predict which if two has strong correlations? I want to take the one with the strongest correlation. When will the next recession occur? Dwayne, I don't know when the next recession will occur. When the numbers click into place, when unemployment starts to pick up, when stock markets start to dip a little bit. The Federal Reserve has some great recession indicators. They're in the webinars I've done on TradeStation. I'm not going to repeat this. Go look at those. But the Federal Reserve System has some phenomenal indicators for recessions. So I'd look at those indicators, and they're telling us that we're not close to a recession at this time period. The Michigan Consumer Confidence Index would be a pretty good one. There's just a bunch of them that the Federal Reserve does, so pay attention to them. Don't listen to your broker. Don't listen to me. The Federal Reserve, man, that stuff is really important. Okay, well, I think I've probably taken enough of your time. What works with silver, Thomas? You'd want to just, what works with gold works with silver. So I think we're going to wrap it up here. Can I show the gold chart one more time? Sure. There's the gold forecast. You can take a screenshot of that. What is the name of the Fed recession indicators? Having a senior moment here. Just watch the TradeStation webinar I did on it, and you're going to get them from there. Or Google Fed recession indicators. You'll get it from there. Do you think copper has no? Copper's what has lots of predictive value is the Baltic Freight Index. Yeah, but copper's still a good predictor. Well, thank you guys and gals so much for being here today. It's so comforting. It really is. It means a lot to me. You always wonder, like, well, anybody going to come listen to me? Am I passe yet? I guess I'm not. So I want to thank you so much for being here. And I hope you learned a little bit today. I hope it's opened a door to you to think about, we can see the future in the market. That's what I'm all about now. I want to know the future. Here's one way we can get a glimpse of the future. So until next time, wishing good luck, good trading. Thank you guys and gals so much for being here today. Real joy to have you in my life. Thank you again very, very much.
Let's have a great trading day this week. Thanks very much for coming in today.